The calendar currently reads January 8th, 2026. Tomorrow, January 9th, 2026, is a day that might go unnoticed by the mainstream media. However, for those who monitor the silver markets closely, it may be remembered as the starting point of a historic shift. Silver prices dipped below the $80 mark. Yet, do not let surface-level movements fool you. This drop is far more significant than a simple market correction. After a spectacular 150% climb throughout 2025, which crushed a 40-year price cap and followed 5 straight years of global supply deficits, the world's major financial powers were fixated on one specific number, 772. Trading desks in China reported their lowest inventory levels in an entire decade. In the US, experts were deeply split, with some daring to predict a move to $100, while others saw a trajectory toward 175. Then, on January 9th, a quiet but monumental shift occurred. It was one of those exceptional market moments where the ripples reach far beyond the trading floors of London or New York. Its impact is felt across every continent. This is exactly why you are watching, because understanding the current state of silver is about much more than just trading. It holds deep significance for anyone trying to grasp the broader reality of currency value and true wealth. If you prefer deep insight over hype, hit that subscribe button. It's not about the numbers for us, but because being truly informed is the most valuable asset during times of market chaos. On January 9th, silver investors looked at their charts to see 77.2 per ounce. No, that wasn't a typo. That specific figure wasn't about breaking a record. It was a clear signal of a major transition. Just 48 hours prior, silver was holding steady above $80, riding a 3-day rally that had filled the market with optimism. Suddenly, that drive vanished. Media outlets labeled it as simple profit-taking, investors locking in returns after a massive run. But veteran silver watchers knew the story went much deeper than that. A year ago, silver was stalled near $30 an ounce. It was steady, quiet, and predictable, so boring that most traders ignored it entirely. But by December 2025, it had surged to $70, a stunning 150% climb that made fortunes for some and left others full of regret. January 9th was not a conclusion. It felt like the first act of a brand new play. Analysts weren't just guessing when they targeted the 77.72 range, with fluctuations expected between 80 and 73. They were spotting subtle patterns that most people miss. The context of the world stage was vital. The US dollar was gaining strength, major economic reports were looming, and the Federal Reserve was poised to make moves that could disrupt the global financial order. While 80% of experts expected rates to stay put, Fed Governor Stephen Moran hinted that aggressive cuts might be needed to keep the economy moving. Traders reacted immediately, sending tremors from Wall Street to Hong Kong. Growing geopolitical friction only made things more volatile. U.S. involvement in Venezuela, alongside rising heat between China and Japan, reminded the world that chaos always drives a hunger for physical assets. Silver, and to a slightly lesser degree gold, became the ultimate refuge. But the core story was always about supply. For 5 years running, global demand has outpaced what mines can produce. In 2025 alone, the deficit hit a massive 63.44 million ounces. That isn't just a small gap. It's a fundamental breakdown in the market structure. Unlike other commodities, silver is mostly a byproduct of mining for gold, lead, or zinc. You can't just flip a switch to mine more silver when the price jumps. Shanghai's markets showed dangerously low stocks late last year. Physical metal was vanishing from vaults at a high rate. Leasing costs spiked, and borrowing fees grew heavy. This wasn't a paper problem. Real metal was becoming hard to find. Industrial use isn't slowing down at all. Solar energy alone consumes over 25% of all annual silver production. Electric vehicles need it for sensors and circuits. The explosion of AI is driving massive demand in data centers. Silver is no longer just a coin in a vault. It's a strategic requirement. In 2012, the U.S. even labeled it a critical mineral for national security and economic growth. Looking back at January 9th, technical data showed silver was heavily oversold. Support was holding near 73, while resistance sat around $82 to $85. But the real story is historical. For 40 years, silver struggled to stay above $50. Every time it got close, panic selling began, fueled by memories of the 1980 crash. The 90s saw no progress. The 2000s saw rallies that ended in tears. 2011 was another failed attempt. Silver simply couldn't hold its ground until 2025. Last year, silver finally broke its chains. The famous cup and handle pattern, which took decades to form, finally finished. It was a base so large that no expert could ignore it. The breakout was nothing short of legendary. After being held down for 40 years, the pressure finally exploded. In January 2025, silver started at $30. By March, it was at $36. Decent, but not shocking. Then came August 14th, when it broke $38, signaling a total shift in market sentiment. Cautious investors finally jumped in. Momentum built quietly until October 17th, the real turning point when silver blew past $54. The 40-year wall was gone. Trading floors went wild, computer algorithms shifted, risk managers scrambled. If silver could break a 4-decade pattern, how high could it go? The rally wouldn't quit. Fed rate cuts in December pushed it past $64 and into the 70s by year end. Q3 of 2025 closed at 64.66, proving this was institutional buying, not just retail hype. Pension funds and central banks were holding silver at these new highs, showing massive confidence in a market that used to be seen as a dead zone. The data underneath told a more powerful story. The world was eating through more silver than it could produce, year after year. Even though the 2026 gap was expected to narrow slightly, the core problem remained. Industrial need, tight supply, global tension, and central bank moves created the perfect storm.